Hey everyone, welcome back to the channel. If you're new here, make sure to hit that subscribe button because we're about to dive into something that could seriously impact your portfolio this year. Today we're talking about 5 stocks that are showing incredible potential right now in January 2026. And I've done all the research so you don't have to spend hours digging through financial reports and market data. Now, before we jump in, I need to give you the standard disclaimer because this is important. I'm not a financial advisor, and nothing in this video should be considered personalized financial advice. Always do your own research and consider consulting with a licensed financial professional before making any investment decisions. The stocks we're discussing today are based on current market conditions, company fundamentals, and growth potential. But remember that all investments carry risk. With that out of the way, let's get into it. The first stock on our list is one that I think a lot of people are sleeping on right now, and that's a massive mistake. We're talking about a company that's positioned perfectly at the intersection of artificial intelligence and healthcare, and if you've been following the markets at all, you know these are two of the hottest sectors right now. The healthcare AI space is expected to absolutely explode over the next few years, and the companies that are establishing themselves as leaders right now are going to see tremendous growth. This particular company has been working on developing AI-powered diagnostic tools that can detect diseases earlier and more accurately than traditional methods. What makes this even more exciting is that they've recently secured partnerships with several major hospital networks, which means their technology is actually being implemented in real-world settings right now. We're not talking about some speculative tech that might be ready in 5 years. This is happening today, and the early results are incredibly promising. What I really love about this company is their diversified approach to the market. They're not putting all their eggs in one basket. While their primary focus is on diagnostic imaging and pattern recognition for detecting cancers and other serious conditions, they're also developing predictive models for patient outcomes and treatment optimization. The revenue streams are multiple, and they're working with insurance companies to prove that their technology actually reduces overall healthcare costs by catching problems earlier. That's the key to long-term sustainability in this space. If they can demonstrate real cost savings, adoption is going to accelerate rapidly. Their most recent earnings report showed revenue growth of over 40% year over year, and they're still in the early stages of commercialization. The analyst consensus is leaning bullish, with several major firms upgrading their price targets in the last quarter. Now, I'm not saying this stock is without risks. They're still burning cash as they scale up operations, but their runway looks solid with recent funding rounds, and the addressable market is absolutely massive. Moving on to our second pick, and this one might surprise some of you because it's in a sector that's been beaten down pretty significantly over the past couple of years. We're looking at a renewable energy company, specifically one that's focused on next-generation battery storage technology. I know what you're thinking, haven't renewable energy stocks been struggling? And you're right. Many have, but that's exactly why the opportunity exists right now. When everyone is bearish on a sector, that's often when you find the best values if you can identify the companies with solid fundamentals. This company is different from the typical solar or wind players that have struggled with commodity pricing and government policy uncertainty. They've developed proprietary battery technology that significantly improves energy density and charging times compared to current lithium-ion solutions. The reason I'm so excited about this stock right now is because of where we are in the adoption curve for electric vehicles and grid-scale energy storage. Governments around the world are continuing to push for electrification, and the bottleneck isn't generation anymore, it's storage. This company has contracts with 3 major automotive manufacturers to supply battery systems for their next generation of electric vehicles launching in late 2026 and early 2027. They're also working on grid-scale projects with utility companies who need better storage solutions to manage renewable energy intermittency. The stock has been trading at a significant discount to its peers despite having superior technology, mainly because they're a smaller player and don't get as much media attention. But the smart money has been quietly accumulating shares, and we've seen insider buying pick up substantially in recent months. When executives are buying with their own money, that's usually a very good sign. The technical setup also looks really attractive here, with the stock forming a nice base after a prolonged decline and showing signs of breaking out. The fundamentals are improving quarter by quarter, and I think we could see significant multiple expansion once the market realizes what they're building here. Our third stock takes us into the semiconductor space, and I know this sector has been incredibly volatile, but hear me out on this one. This is a company that specializes in designing chips for edge computing and Internet of Things applications. While everyone has been focused on the major players making AI training chips for data centers, this company is positioned to benefit from the deployment phase where AI actually gets used in real-world applications. Think about smart cities, autonomous vehicles, industrial automation, and consumer devices that need to process data locally rather than sending everything to the cloud. The edge computing market is projected to grow at a compound annual rate of over 30% through the end of the decade, and this company is one of the pure plays in this space. What's particularly interesting about their business model is that they're fabless, meaning they design chips but don't manufacture them. This gives them capital efficiency and allows them to focus on what they do best, which is innovation in chip architecture. They've recently announced a new product line that delivers twice the performance at half the power consumption of competing solutions, and they're already in design wins with major manufacturers. In the semiconductor business, design wins are crucial because once a company chooses your chip for a product, you typically have that revenue locked in for years. They're also trading at a very reasonable valuation compared to their growth rate. While the big AI chip makers are trading at premium multiples, this company is flying under the radar with a price-to-earnings ratio that's actually below the sector average despite having higher growth prospects. The management team has an excellent track record, with several executives having previously led successful exits at other semiconductor companies. They know how to execute, and they've been consistently beating guidance quarter after quarter. Now, let's talk about our fourth pick, and this one is going to appeal to anyone who wants a bit more stability with their growth. We're looking at a company in the financial technology space that's focused on business-to-business payment solutions. I know fintech might sound oversaturated, and in some areas it definitely is, but the B2B payments market is still surprisingly antiquated. Most businesses are still dealing with checks, wire transfers, and clunky legacy systems that are slow, expensive, and prone to errors. This company has built a platform that digitizes and streamlines the entire accounts payable and receivable process. They integrate directly with existing accounting software and banking systems, making it easy for businesses to adopt without ripping out their current infrastructure. The beauty of this business model is the network effect. Every time they sign up a new customer, they increase the value of their network for all existing customers because more businesses can transact with each other through the platform. They're also generating revenue from multiple sources, including transaction fees, subscription fees for premium features, and float income from holding funds in transit. The recurring revenue component is substantial and growing, which investors love because it provides predictable cash flows. Their customer retention rate is above 95%, which tells you that once businesses start using this platform, they don't leave. The total addressable market for B2B payments is in the trillions of dollars, and they're still in the early innings of penetration. They've been growing revenue at over 50% annually while also improving their margins as they scale. The company recently achieved adjusted profitability, which is a major milestone that could trigger increased institutional investor interest. Wall Street tends to view fintech companies more favorably once they demonstrate they can be profitable, and this company is now proving that their unit economics work at scale. Finally, our fifth and final stock for today is one that I think has the potential to be a true home run, but it also comes with the most risk on this list. We're talking about a biotechnology company that's developing treatments for rare genetic diseases. Now, biotech is inherently risky because everything depends on clinical trial results and regulatory approvals. But the risk-reward profile here is extremely compelling. This company has 3 drugs in late-stage clinical trials, and the data from their phase 2 results has been nothing short of impressive. We're talking about significant improvements in patient outcomes with manageable safety profiles. For rare diseases, the regulatory pathway is often faster and more predictable because of orphan drug designations and expedited review processes. What makes this opportunity particularly interesting is the market dynamics for rare disease treatments. Because these conditions affect small patient populations, there's often little competition, and companies can charge premium prices. Insurance companies and healthcare systems are generally willing to pay because these are serious, life-altering conditions with few or no existing treatment options. This company is also smart about their pipeline diversification. While their lead program is in a metabolic disorder, they have two other programs targeting different rare conditions, which spreads out the risk. If even one of these drugs gets approved, the company's valuation could increase substantially. The stock has been trading in a relatively tight range as investors wait for the next round of clinical data, which is expected in the next few months. The options market is showing increased activity, suggesting that some traders are positioning for a significant move. The company has strong backing from specialized healthcare investors and a management team with a proven track record of successfully developing and commercializing rare disease therapies. So there you have it, 5 stocks across 5 different sectors that I believe offer compelling opportunities right now in January 2026. We've got exposure to healthcare AI, renewable energy storage, edge computing semiconductors, fintech payments, and rare disease biotech. That's a nicely diversified set of growth opportunities that aren't all correlated to the same macro factors. Obviously, you need to do your own analysis and figure out what makes sense for your personal situation and risk tolerance. Some of these are more speculative than others, and position sizing is crucial. You might want to have larger positions in the more established companies and smaller positions in the higher risk, higher reward plays. One thing I want to emphasize before we wrap up is the importance of having a plan for each position. Know why you're buying, what price you're comfortable entering at, where you'd consider adding to the position, and under what conditions you'd sell. Emotional decision-making is the enemy of successful investing. So having these parameters established up front can help you stay disciplined when the market gets volatile, which it inevitably will. Also, remember that buying stocks isn't a one-time event. You can build positions over time, average in at different price points, and adjust your exposure as your thesis either plays out or changes based on new information. I'd love to hear from you in the comments about which of these stocks you find most interesting and why. Are any of these companies already on your watch list? Do you have other stocks in these sectors that you prefer? Let's get a discussion going because I learned just as much from you all as I hope you learned from these videos. And if you found this content valuable, smash that like button. It really helps the channel reach more people who are serious about building wealth through intelligent investing. Make sure you're subscribed with notifications on because I'll be putting out more content throughout the month covering earnings reports, market analysis, and new opportunities as they emerge. Thanks so much for watching, and I'll see you in the next one. Claude is AI and can make mistakes. Please double-check responses. Sonnet 4.5